OptionChampion.com.
Today is Friday, August 12th. I'm Rick Adams, and this is Tricks of the Trade.
All data and other information contained throughout this video are for demonstration purposes only and shall not be construed as trading or investment advice or an advertisement for software or other trading applications, nor shall any part of this presentation be considered a recommendation of securities or other tradable products or related strategies. Trading and investing, whether short or long term, involve risks that may not be suitable for everyone. Any mention of past performance is not an indication nor a guarantee of future results, as volatile market conditions can arise at any time and result in substantial losses. No individual should make any trading or investment decisions without consulting a professional and conducting his or her own research.
Welcome to Tricks of the Trade on this Friday as we wrap up another week of economic data. For the month of July, producer prices fell by 0.5% from a month earlier and increased 9.8% on an annual basis. Consumer prices were unchanged month over month and rose 8.5% from the same period a year ago. Weekly jobless claims, however, increased by 14,000 to 262,000 compared to the revised 248,000 in the prior week. The markets were green across the board for the week. The Dow gained 957 2/3. The S&P 500 gained 134. The Nasdaq Composite gained 387.5. The Russell gained 93 3/4. And all those gains crushed volatility, with the VIX coming in by $1.62 on the week. Back on a bull run for the time being. Crude oil finished the week higher by $3.35. Gold up $26.50, silver up 98 cents, and natural gas gained 77 cents on the week. All right, we're going to look at a multi-leg strategy from earlier in the week. A multi-leg strategy is two or more positions that are combined into a single strategy. A multi-leg strategy can have many advantages, such as providing a hedge, reducing cost, limiting risk, and profiting from various directional moves in the underlying stock. There are two-leg strategies, such as covered calls, protective puts, strangles, straddles, vertical spreads, and calendar spreads, and multi-leg strategies, such as ratio spreads, collars, iron condors, and butterfly spreads. This week, I had a custom multi-leg strategy on Freeport-McMoRan, symbol FCX on the New York Stock Exchange. The strategy had 4 legs, where I was long the stock at $29.94 per share, short a 31 call, long a 30 put, and short a 27 put. If we dissect this strategy, we will see that it was comprised of several embedded strategies. A covered call with the long stock and short 31 call, a protective put with the long stock and long 30 put, a $3 wide long vertical put spread with the long 30 put and short 27 put, and a $4 wide short strangle with the short 31 call and short 27 put. Let's move the long stock leg aside for a moment and look at the option legs from a cost perspective. I bought the 30 put for $2.16, so if I had just this put option only and nothing else, it would have been for a net debit of $2.16, or a cost of $216, as the put option would represent 100 shares of stock. That put option cost can be reduced by selling other options on top of it and receiving credits. The more credits received, the greater the reduction of the initial debit. And that's where the embedded short strangle comes in. I sold the 31 call at 90 cents and the 27 put at $1 for a combined credit of $1.90. Add that $1.90 credit to the $2.16 debit of the 30 put, and the total debit is reduced to 26 cents. Now let's bring the stock leg back into the mix. I bought the stock for $29.94 per share. If I had just bought the stock and nothing else, my total cost would simply be the $29.94 that I paid for the stock. But in this custom strategy, I also have the option legs. What impact does that have on the cost? Well, I also paid $2.16 for the 30 put. So add that to the $29.94 paid for the stock, and my total cost increases to $32.10 per share. That's quite an increase. That means the stock would have to go up $2.16 per share to cover the additional cost from the put. So to minimize the impact on cost, I sold the 31 call and 27 put for a combined credit of $1.90, bringing my overall cost to $30.20. So altogether, those options added just 26 cents to the overall cost of the strategy. A very minimal impact. From a directional standpoint, the long stock and short put are bullish positions that would profit from the stock going up. The long 30 put and short 31 call are bearish positions that would profit from the stock going down. And the short 27 put and short 31 call together is a neutral position that would profit from the stock price remaining between the 27 and 31 strike prices of those options. I put this strategy on Tuesday, the 9th, and the next day, the stock rose as high as $1.65 to $31.59 per share. That was not good for the long 30 put leg of the strategy. So I closed that leg to release some of the debit and took a $51 loss on that leg. And then yesterday, the stock rose as high as $1.43 to $32.83 per share. So I closed out the remaining legs of the strategy for a total profit of $118. That's it for this episode of Tricks of the Trade. I'm Rick Adams. Thank you very much for watching. See you next time.